Assalamu alaikum. Hello and welcome to Gurukul Online Learning Network. Today I'm instructor Sheikh Mahadi. We're going to study financial management and organization. So our today's chapter is chapter 4, financial statement and analysis. So in the previous classes we learned about the ratios of the math and the financial statement analysis, and we said is from the financial statement analysis we will be taking certain elements and putting them into our next classes maths. So we did something about the gross profit or the acid test ratio or the normal general terms profit ratio. So today we are going to turn over to the leverage ratios. What is leverage? So leverage ratios, number one. So within the leverage ratios we can go first debt ratio. What is debt? Debt means debenture. Debt ratios is the formula for that is total liabilities divided by total assets. Total liabilities means the total amount of money that we are liable to our creditors, which we have to pay, the amount of money, which is 1,643,000 is the total liabilities, and the total asset are 3,597,000. So divide the total liabilities with the total assets, we get 0.46. We take that to percentage, break it down to percentage, we will get 46% of the total debt ratio. So secondly, debt equity ratio, just like the acid test ratio, it's another part of the debt equity. Debt equity is long-term debt divided by equity capital. Both the numbers will be given in the questions. So the numbers of these are just normal random numbers. This is 1,023,000 divided by 1,954,000. So if we divide that, we will get 0.52. Break it down to percentage, we will get number 52%, which is the debt equity ratio percentage. Time interest earned ratio. Time interest earned ratio. What does that mean? Time interest ratio. It means over time the amount of interest we are earning that is falling into the category of rationalized. So EBIT divided by interest. EBIT. This term will be specifically included in the textbooks or even in the question. EBIT refers to directly time interest earned ratio divided by interest, the amount of certain percentage of the interest they are giving. We did not choose any random numbers for this though. It will be taken normally from the textbook. Solve it over there. Okay. So secondly, gross profit ratios. So as we mentioned earlier, we will be taking some elements from the financial statement, which is I mentioned the gross profit. So the gross profit divided by sales. How do we get the gross profit? We get the gross profit from sales minus sales less cost of goods sold. So we deduct the amount of cost of goods sold from sales. That's how we get gross profit. So gross profit is 986,000 divided by 307,400. That will bring us to 3.2. If we break it down to percentage, we will get 32%. So let's take a look at operating profit ratios. As we mentioned earlier, we will be taking those elements. Operating profit is one of those elements. So operating profits ratio is EBIT, as mentioned over here. EBIT, time interest earned ratio. EBIT, it will be given as per perception said. EBIT is 418,000. Sales, the amount we sold, amount of money is 3,074,000. So if we break it down, we just divide it by these two, we will get 0.1360. Break that down to percentage, we will have 13.60% in our hand. So that will be the operating profit ratio, 13.60. Net profit margin. This is another element of the financial statement analysis. The net profit which we get at the end of every year. Net profit margin. EAT. EAT means earning after taxes. The earning we have after tax is called the EAT. So EAT divided by sales. EAT is given 221,000. 221,000 divided by sales. Sales is 3,074,000. So 221,000 divided by 3,074,000, we get 7.72. Yeah, 0.720. 0.720 divide, break down that into percentage, we will get 7.20%. That means 7.20%. 7.20%. Right over here. Then lastly, EPS. EPS, the term will be given directly in the question. So EAT is earning after taxes. Here, earning after tax is EAT. So EAT divided by number of common stock. So EPS means earning per share. Earning per share. That means we bought some general shares from a company, from a given public company. The amount of share that we bought and the amount we are getting the profit from each share is called the earning per share. So the calculation for per share, profit for per share calculation is EAT, earning after taxes, divided by number of common stock. Number of common stock means number of general shares. So EAT was given 221,000 and number of common stock was whopping 762,062. 76262. So if we divide that by, the calculation will be 2.90 taka. So earning per share is only 2.90. Up to this level, we'll talk about the gross profit ratio, the profitability ratio, and the leverage ratio in this class. So let's talk about the leverage ratio or the capital structure ratio. That we just did the formulas and the maths. Let's discuss about what is leverage ratio mainly called. Leverage ratio is called to judge the long-term financial position of a firm, or financial leverage of capital structure ratios are calculated. These ratios indicate mixed funds provided by owners and lenders. What is called a mixed fund provided by owners and lenders? Owners of a company are the initial people who started the business on their own. The general board of directors, the CEO, and the other lenders. Lenders are the insurance banks or the financial companies or the banks that we have taken loan from. And even in the initial, there are the general shareholders. So those two mixed are called the mixing of the finance of the company. As a general rule, there should be an approximate mix of debts of owner's equity in financing of the firm's assets. So every firm, in every financing, there is always a mix of two parties, the owners and the lenders. The owners and lenders, they both team up, they all take their funds together and then form up a company. A company just cannot run on its own fund of the owners. It definitely lends from others in the debentures, which are the creditors of the company. So number A, debt equity ratio or the debt asset ratio or the debt capital ratio, which is commonly known as the debt ratio. We just named it in a most simple way. So what is debt ratio? The debt ratio measures the proportion of total asset financed by the firm's creditors. So proportion of the total assets. A company has huge amount of assets, but all of those are not from the firm's creditors. A portion of a fraction of that asset is taken from the creditors. The higher this ratio, the greater the amount of other people's money being used to generate profits. That means the more the debt ratio will be, that means the more the ratio of the firm's creditors' total asset investment is, the more the company will be able to generate profit ratio. So that is the debt ratios calculation, and that is the formula. So in the next chapter, second B, in the next page, we can see the debt equity ratio. Debt ratio was this one, and debt equity ratio is a bit just like the acid test ratio from the previous one. So if we take a look at the debt equity ratio, it means clearly the relationship between borrowed funds and owner's capital is a popular measure of long-term financial solvency of a firm. So every firm that operates on its own, it is for a long term. Even if it's mainly a company, it goes for a very long period of time. So that's why they said the relation between borrowed funds and owner's capital. Borrowed funds are the loans taken from bank and other financial institution. It may be even NGOs or the banks or the insurance company, whatever those may be, or even the local people that are giving loans or funds, or maybe other rich potentials. So the long-term financial solvency of a firm, this relation is shown by the debt equity ratio. The amount that we have to calculate or the measurement is taken by the debt equity ratio, just as the previous one. So this ratio indicates the relative proportions of debt and equity in financing assets of firm. The ratios are the debt equity ratio. This is the equation and the formula given as follows. Thirdly, there are called the time interest earned ratio. This is the EBIT, interest. As I mentioned that this will be given already in the section where the question would be. So time interest earned ratio measures a firm's ability to make contractual interest payment. Sometimes it is called the interest coverage ratio. So what do we get by that? Firm's ability to make contractual interest payment. If your firm, it measures the ability that your firm has enough capability to pay how much interest per year. That is called the time interest ratio, which is basically in short form called the EBIT. So it is being calculated like this one. So in case of that, profitability ratio, we can take a look at the gross profit ratio and the operating profit ratios or the net profit margins. So, profitability. A company should earn profit to survive and grow over a long period. Profit is the difference between revenues, expenses over a period, usually 1 year. These profitability ratios are called the operating efficiencies of a company. That is basically a general term for profitability ratio. It is a general term for those ratios. These are just easy. These do not need any kind of explanation or comment. So, gross profit ratio, operating profit ratio, and net profit margin, and EPS. EPS is earning per share. It requires a very small amount of definition, but we will thorough it in our next classes. So if you have any kinds of questions regarding this class, please let us know down in the comment box below, and be with Gurukul. Thank you.